Hello, dear eTorians. This is PC here from Global Alpha Search. We just finished another month, so it's time for a quick update of how we performed with our portfolio in February 2022. We actually had another great month, outperformed our internal benchmark, and we also outperformed the equity indices by quite a bit. And I will just explain you in details what was the reason for all that in February. Also, what are my thoughts on the market right now and how I think we should navigate going forward. So let me just quickly present you my screen. And we'll go from there. Okay, so February 2022, we had another great month as a portfolio. First of all, I'd like to thank all the new copiers that joined our portfolio in February. Our copiers count rose by almost 190 points. So thank you very much for that. It's a great motivation for me to do even harder work for you to be providing stable, long-term positive alphas for all of my copiers and myself as well. So let's get to the details of the portfolio overview. The synthetic internal benchmark that currently consists in 50% of the S&P, 20% in gold, and 30% in long-term treasuries represented by Tilt, has been basically flat, lost a tiny little bit in February. But our Global Alpha Search portfolio managed to be up 5.5% this month. So we have beaten our synthetic internal benchmark in a very good way. I will just get to the details on why that happened again in February, because as you possibly remember, in January we had a great month too. And we managed to navigate through the downside volatility quite nicely. The S&P, just for comparison, was down 3%. The Nasdaq 100 was down slightly more than 4.5% on month. So this is the portfolio structure as of today. Obviously, the structure swings throughout time, so don't pay that much of an attention to, but please do note that currently we as far as equity allocation is, we are in line with our cycle phase reading, which is boom. So we're keeping approximately between 40 to 60% equity allocation. Exposure looks a bit different, obviously, because we're not fully invested. We have quite a bit of cash on the account right now. Almost 40% of the account is basically cash as of today, as of end of February. So as far as exposure is concerned, we're approximately 60% exposed to stocks, excluding uranium miners, because I kind of count them together with other commodity exposure like gold. And all in all, the aggregate equity exposure with ETFs, because I have started adding some directional plays to the upside on the S&P today via the SPXL, so the leveraged S&P 500 long ETF, that increases the exposure a little bit, of course. So as far as exposure is concerned, we're like slightly less than 17% right now. But as I said in some of my comments recently, I plan to be agile as far as the portfolio exposure is. I think there's still quite a bit of volatility this year coming, so I'm just using the opportunity to basically take advantage on some beaten down market opportunities. The shorts that have basically been mostly hedging our long equity exposure and adding some downside tilt to the overall portfolio have been all closed. The last one was closed yesterday. As of now, I'm planning to be either long stocks only, or basically adding some longs for directional plays. I do not still obviously exclude hedging in the nearest future. The situation is extremely dynamic, especially after the the war between Russia and Ukraine has started on Thursday last week. We'll talk about this a bit later on. Treasuries, we still have slightly less than 6% as far as exposure is concerned. So we're below our benchmark for the cycle phase, but this is a deliberate move because of the inflation and the Fed being basically behind the curve. Most possibly, we will see the 10-year yield falling further from here, unless we have bouts of buying safe havens like we had over the last couple of days. But in general, one should expect the yields, long-term yield, to be higher going forward. So we do want to be underweight versus our benchmark for treasuries for the current cycle phase. Gold exposure mostly kept through ETFs and CFD exposure on the long side, mostly because of the fact that those instruments are traded longer also before and after the US market is open. So I'm just kind of adding them all up right now to play a general exposure for us in gold as a way to catch the inflation hedge, and also use it as a safe haven long in terms of massive volatility bouts like we saw over the last couple of days. We also still have a little bit of crypto, but I don't plan to do anything with this. It's a basically longer term little bets on the metaverse, and this will most possibly not change for the foreseeable future. Risk over February was fully contained. Our average was as low as 1, so we managed to achieve a great risk-reward ratio this month with a risk score as low as 1. We managed to be up 5.5% on the whole portfolio. Maximum risk was 3. We're pretty much ending the month with a risk of 3 as well. So our maximum for February, mostly because of the fact that the long equity hedges were taken off over the last couple of days. No major reshuffles done in equity longs. I think we're well positioned for now. We also have the expected overall equity allocation, so not planning any sizable changes in terms of the participants of the equity portfolio for now. Most of the actions in February were concentrated on hedging and the minimalization of downside swings of capital. So this was it. We also increased exposure to gold. This added quite a bit of alpha to the portfolio in February as well, and we kept a relatively big cash buffer between 10 to 35% throughout the month, which helped us outperform our synthetic internal benchmark quite nicely. So all in all, we outperformed the synthetic internal benchmark by over 5 percentage points, almost 5.5. And for comparison, only obviously because it's not our official benchmark, we also did manage to outperform the S&P 500 by as much as 8.5%. So great performance in February. We had start of the year just as good as we could imagine, pretty much, given how much down the equity indices were and how much volatility was there in the markets. So we both finished January nicely in the green, and so did we in February. The major reasons for our performance last month were this month, sorry, still 28th February as I record this video. The major reasons for outperformance were our hedges on the equity exposure, obviously, and overall exposure tilted to the downside to futures or CFDs, long gold exposure as an inflation hedge, and safe haven asset. So we managed to minimize the downside risk, and we did manage to fulfill our major target, which is the portfolio's protection in February. Let's move on. Major market drivers in general for February. I think that the market was generally pricing in the inflation and monetary policy changes throughout most of the month, and then at the end of the month we had the bout of panic around the Russian invasion on Ukraine, which has basically been the turning point, at least for now, as we basically saw the lows for now, at least on both the S&P 500 and the Nasdaq 100, right after the Russian invasion on Ukraine, which was Thursday night. Yeah, S&P is currently in the correction territory. The Nasdaq is pretty much or was momentarily in the bear market. Right now it's less than 20% from its recent top, but we had a big correction. Going forward, I think the situation is just basically geopolitically as dynamic as you can ever imagine. So normally, I do not think that we should be facing recession, but I do admit, and many other market analysts do admit, that potential recession risks did rise recently. Obviously, going forward, it will all depend on how things unfold. So massive economic sanctions on Russia from the West. I don't think we want to dig into the details. Most of you guys are fully aware of what has been happening over the last couple of days, so let's just keep it as simple and as general as we can for now, not to take too much of your time. We will most possibly also see higher inflation ahead. Commodities have been ripping throughout February, and they got even higher because of the invasion that happened last week. Just moving on now quickly to the Fed overview, because this is obviously still one of the crucial things for the pricing of risky assets like equities. The current level of Fed assets is still 8.9 trillion, so we're pretty much here at the top. We're still expecting this graph showing the level of the balance sheet of Fed to kind of flatten out, and then later in the year, start dropping, because as the Fed has announced, they do plan a balance sheet runoff. I deliberately kept those two graphs from the last month's presentation because I think they are very important to be watching this year, and just to keep them in mind. The CPI to 10-year ratio is also showing how serious the situation is for the Fed in terms of basically being behind the curve with fighting inflation in general. So the Russian-Ukrainian war poses obviously another pro-inflationary argument via commodity prices shocks, and this is still another issue for the Fed to consider. Depending on how things unfold further, recession risks are rising. I've already mentioned that, and the Fed is in a trap. It was in a trap already in January, and it's now in even a bigger trap because high and accelerating inflation versus the risks of slower growth and sudden recession caused by the war. This relation has basically been deteriorating over the last week. So I do expect that although in March the Fed will increase the Fed's rates somewhere between 25 to 50 basis points, I think they will use this opportunity to basically kind of take a break a little bit on their recent more hawkish rhetorics because of what has been happening on the geopolitical front. So we'll see in less than a month, pretty much. Just a quick look at the inflation in US. As you see, again, I do highlight in yellow the readings that are higher than last month. So you see, out of a set of the most commonly used inflation readings, the vast majority of them is still on a growing trend, and this trend seems to be accelerating, even though many economists were expecting last month readings to be a peak in the midterm for US inflation, and given the recent happenings in Russia and Ukraine, and what was happening with oil prices, I do think that basically this pressure will be higher for longer as far as inflation is concerned. Worldwide macro heat map for the 10 biggest economies in the world, and again, 1, 2, 3, 4, 5, 6, 7 out of 10 have yet faced higher inflation readings than a month ago. So it's not only US, but the whole developed world that is seeing this pressure, and the recent happenings will obviously only make it worse. Inflation is still the biggest growing issue. Central banks are in a trap. I've said that, but we should be repeating this because this is basically a big issue, and we are in a boom phase. So bull phase, please do remember, it's basically a time when the risks of black swans happening are rising, and we pretty much had one black swan happening last week in terms of geopolitics, which will have massive influence on economy, not only the Russian but the global, especially the European economy as well. Commodities, big trouble. That's what I called this slide, because this is pretty much a big trouble. We are living in a world of changing paradigm for low inflation for longer into higher inflation for longer, and as you see here, very well, commodities are basically going to be the major source of inflation going forward. So it's not going to be a demand-driven inflation, but rather mostly supply shock-driven inflation, which will obviously kind of influence the central bank's policies against this inflation, because this is something that they cannot influence. So obviously they will not be willing to kind of kill it in a way they would fight a demand-driven demand-driven shocks for inflation. Sorry. So yeah, as you see here, crude oil up 56% year on year, natural gas up 60% year on year, gasoline 43%. You have coal up 234% year on year. You have methanol. Well, this one is not much that up, but you know, other major energy sources are up basically between you know, double digit to high double digit and even triple digit year-on-year growth. So this is really serious, and it's not only the energy sources, but other commodities that are ripping as well. The agricultural space have been up over the last year quite substantially as well. So food is basically getting more expensive. You see metals, some of the metals at least, being up in year-on-year terms somewhat as well. But obviously they are kind of having a different characteristics. So industrials also are something that is kind of a big trouble in terms of commodity changes year on year. Magnesium, soda ash, neodymium, you have cobalt, you have aluminium, you have tin up between 50, 60, 70, or a couple of 100%. So that all adds up basically high double or even triple digit year-on-year changes in terms of commodities. And I think we should be expecting these trends to continue going forward in the nearest future. And here is something I wanted you to pay attention to. This is the most recent macro market perspectives piece from BlackRock, issued on the 20th of January. So like slightly above a week ago, and it summarizes quite nicely a couple of very important things in terms of what we're facing right now. I've highlighted them in yellow, so I'll just read them now for you to make it quicker. We're in a new and unusual market regime underpinned by a new macro landscape where inflation is shaped by supply constraints. The key to understanding the muted response of central banks to inflation is not the time frame, but its cause, which is supply. Whether or not carbon emissions are reduced, we believe climate change will increase inflation. In addition, a reviewing of globalization and population aging in China are reducing the supply of cheap imports from China to developed markets. This will raise costs and force further resource reallocation in those markets, making supply constraints more common, and geopolitical risks threaten to disrupt energy supply. And now the most important, I think, at least in my opinion, a world shaped by supply constraints will bring more macro volatility. Monetary policy cannot stabilize both inflation and growth. It has to choose between them. We think central banks should live with supply-driven inflation rather than destroy demand and economic activity, provided inflation expectations remain anchored. When inflation is the result of sectoral reallocation, accommodating it better outcomes, as recent research shows. Insisting on stabilizing inflation would lead to an over-tightening of monetary policy, more activity sacrificed, and a slowing down of the needed sectoral reallocation. So on the graph here on the left, you can see very well in a longer perspective over 15 years how core goods are basically becoming a problem, right? This is the inflation for core goods and core services. Core services have basically mostly been the reason for inflation pressures over the last 15 years, which have been not big, by the way. But right now we're seeing a massive increase in inflation of core goods. So this is the paradigm, the new paradigm that BlackRock has kind of noted here, and I do agree with that fully. This is a very interesting summary of what's ahead of us, basically. Quick look at valuations and forecasts. Most of the data here, thanks to Yardeni research, are yet from before the recent plunge after the war broke out. But yeah, basically we're now on a one-year forward basis between 18 to 19 times PE for the S&P 500, and the forward earnings and revenues growth, like the major average expected growth, which is 7%, is nicely laid out here. So for the end of this year, the forward earnings are expected to be $2 to $8 for the S&P 500. For now, I am still not changing my end of year target for the S&P 500, which is between 4,900 and 5,000. But I do see downside risks from here should the market consensus for forward earnings be deteriorating because of what's been happening geopolitically over the last week, and what's still possibly ahead of us. This graph is also kept from last month's presentation. This is just basically to remember that right now, in terms of the PEG ratio, the valuations are quite appealing in the longer run. So I do think that assumed no recession, current levels and lower are levels where you basically want to be buying cheaper stocks with good economic mode. Here, the recent drawdowns during the major creases that we had. Right now, the S&P has been down 14%, sorry, top to bottom, which was 2 or 3 days ago, right? So down 40%. Now we've been regaining ground. We'll see how we go forward. Forecasts and expectations. We're still in the boom phase, which started in January. The Russian-Ukrainian issue might be the black swan. We'll see how things develop. The black swan meaning not only for the markets in the short term, but for the whole world economy, in terms of whether we do face a recession or not. The yield curve shape and the incident indicators are crucial to be watched going forward. So industrial production, payrolls, and the delta. I don't have to explain these definitions for those of you who have been already following our macro forecasting tool, which is the enhanced aggregate spread by Dr. Robert Daly from NoSpin Forecast. We're in some of the conclusions, right? We're in a totally new world that is highly predictable due to unfolding geopolitical risks. I think everybody understands it. Investors should stay agile and ready to adjust to changing situation. Supply constraints, something I have already mentioned, are a new inflationary paradigm. In the longer run, I think with higher inflation being so persistent, equities and gold would be one of the best places to hide for investors, much better than bonds or cash. Quick summary of our objectives implementation so far this year. We did manage to consequently keep the downside skew for the portfolio from the very start of January, which helped us navigate the whole portfolio in January and February quite nicely, adding good alpha to the copiers and to my personal portfolio as well. We're still avoiding overpriced growth stocks because of the rising rates, but we're starting to look at some bargain good quality businesses with high moat. The diversification into more value stocks has been mostly done over the period of December and January, so we're planning to keep the portfolio more value oriented going forward as well. The long gold exposure did add good alpha this month, and I think I will most possibly continue to keep a relatively fair exposure to gold. I think it has broken out both in terms of technicals and fundamentals lately, and in a predictable perspective, we should basically see gold higher from here. We kept appropriate cash buffer to be able to minimize risks as well. So that's another objective that was fulfilled over the last 2 months. And we hedged equity exposure to avoid downside volatility, which I think was one of the major reasons for our good performance over the last 2 months, especially February. My view from here, I do believe that the Russian-Ukrainian war does not cause recession, but risks are rising and the thing needs to be monitored quite closely. From here, I plan to selectively be adding longs at some good prices. In general, I do tend to think that I will keep appropriate cycle adjusted exposure limits for a simple reason that our macro tool is basically our major tool, right? So it's first the macro tool, the forecast, the allocation, and then stock picking and stuff like this. I think there's yet more volatility in this year once the Fed starts running of its balance sheet. I think we will have another bout of volatility, possibly later in the year. So I will keep hedging positions most possibly, depending on the market situation. But in the short run, I do believe that the bottom is in. We will see whether I'm right or wrong, obviously. Thank you very much. Thanks to all the new copiers. Should you be consider copying me, please remember that the minimum copy amount that I suggest is $500. Always please do click copy open trades, and do copy for as long as possible. Minimum 1 year is what I think is sensible. And please always be patient and resilient through turbulence. So thank you very much. See you next month.